Okay, good evening, everyone. And once again, thank you for, taking that time to join this class, with the short notice. It's not something that was originally planned, but just to uh, consolidate on what we have done in the past, and also to enhance what we are doing. I thought of, doing this review. I know we did one the last time, and not everybody, were in attendance. But then uh, it's important that this thing called Forex is well understood. Okay. I see, thanks to everyone that has been participating in the group, with your analysis, with your thoughts, and also sharing your opinion is one thing for us to, to collaborate. The essence of the group is to have us, talk to ourselves, even as we progress in our trading journey. You never can tell tomorrow, uh, you can grow and, you can make it out of this group. And it's something that you want to look back at and say, okay, oh, I started from somewhere, and I had this set of people that I collaborated with in the past, and now I'm moving. The prayer is for everybody to move, understand, all the intricacies that are involved in trading, and be able to, place that trade, and that trade will run into profit. That's the most important thing. Uh, no matter how well you know Forex, if you cannot place a trade and at the end of the day you close that trade in profit, then you've not achieved your goal. Okay, so that's why, and my belief is that everyone that has come in contact with Forex and have learned Forex should be able to trade on their own. Yes, I know there are signal groups. There are people that run signal group. There are suggestions everywhere on the internet. But then it's better you understand why this market move from point A to point B. It's better you understand it. It's better you know why this candlestick is like this. It's better you are able to tell that this movement is a pullback and this one is a trend. It's better you're able to tell that, oh, the market is ranging at this point. It's better you're able to do it. Because if you rely on somebody to be giving you signal, and for some reason that person is not available to give you signal, your trading will be truncated. Because if the person does give you signal, you won't be able to progress, you won't be able to continue. So you need to be able to do it yourself. So my push is always for everyone to be able to do it themselves. So this class is going to just be a kind of a review class, and also a question and answer class. And I want to share something on patterns. Okay, I've mentioned it to you previously. When we talk about Forex, we talk about trend. Okay, there's a general notion that the market trends 30% of the time, and ranges 70% of the time. So if you look at it, out of 30 and 70, which one is higher? 70 is higher. That tells you that what the market will do for people to make loss is higher than what the market will do for people to make profits. So it's basically, what you want to do is, how do you profit in both when the market is trending and when the market is ranging? And whenever you see that the market is ranging, I will explain it to you now. We started by saying, okay, let me open Power Fibonacci. Bum, 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 bum. Okay, let's open this next. Okay, I want to use this as an example. All right, so we discussed this before, right? we'll say when the market is moving, the market is going to move from point A to point B, then it will pull back to point C, and then it will move to point D. That when the market does this, the market has completed one full price swing. That's what we said, right? And if the market is going to continue to trend, the market will now continue from here, pull back, go higher, pulls back, go higher, right? So that's what the market does when the market is trending. And of course, if the market is trending up, it will be creating higher highs and higher lows. And when the market is trending down, it will be creating lower lows and lower highs, okay? But now, when the market is ranging, and that's why I'm bringing this topic, okay? When the market is ranging, what the market does in effect is the market creates, so this is your A, B, C, and the market goes to D, right? But when the market is ranging, the market will now create what we call sub A, sub B, sub C, sub D. Now, I want to take you to let me put it, the advanced market analysis. So let's say chart patterns. Let's just go to Google and pick it. Sorry, let me change it to harmonic patterns. Harmonic chart patterns. Okay. All right. So this is what you see, right? So let's take this for instance. I'll try to blow it up so that we can see it very well. Or let's take, okay, so let's take this. This will make it clearer. I hope you guys can see my screen because what I want to explain is very key. You can see that I pulled it from Google. I didn't bring it from any textbook, right? If you go to Google, these things are there. They are all available. Okay. So let's make this one big. And let's see where it's coming from. Okay. So you see, this is called a bullish bat pattern. This is a bearish bat pattern. Okay. Okay, let's see the next one. This is a bullish butterfly pattern. This is a bullish butterfly pattern, right? Okay, and this is a bearish butterfly pattern. Okay. Now, all these things I'm showing you now, there's a little bit of confusion, around it because of the way they are being taught or the way they are being explained. Okay, let me put it that way. Okay, so these are the key patterns. We have Gatly. Usually we start with Gatly. Let me see. So we have Gatly pattern. This is okay, this Gatly. We have a Gatly pattern. Then we have the bat pattern. We have the butterfly pattern. We have the crab pattern. Then we have the cipher pattern. Okay, I think the two most popular is Gatly, butterfly, and cipher. I think they are the most popular, the ones that I know, right? But now, to take away all this confusion, when you hear the name cipher pattern, okay, are you seeing these values? These values that you are seeing here, these values are your Fibonacci ratios, meaning that if the market moves from point X to point A, okay, if you put your Fibonacci between X and A, it should give you either 38.2 or 61.8. That is, the market moves from point S to point A and retraces to either 38.2 or 61.8. And after then, the market extends to 141.4. Okay. Remember, this extension to 141.4, you can see is higher than A. It went above the A. Okay. Now, when this market pulls back, when it comes back down, okay, if the market comes back down, we want to see that this is your A, B, C, D, right? This is your A, B, C, D, original A, B, C, D, right? If you measure this X to C, this market should pull back to 78.6. Now, if all these conditions are met, you will say that this market has formed a cipher pattern. I don't know if you guys understand what I'm saying. It's complicated. With this explanation I'm giving you now, it's complicated, but I'm going to show you this simplified. I just wanted to show you that this is the way, this is how it's been taught. Okay. In fact, I even have let me see if I can pull it out. 1 minute. Trading cloud. Uh, I'm not sure where I studied. So there was somebody I paid. This guy that does. Okay, let me see if I will get it. Stan. Can't find it here. So there's a document. Okay. I paid the guy some time ago. I think it was that was around 2017. Okay. I paid the guy to teach me only chart pattern. Okay, the guy was in Ilorin, Kwara. He has an institute, a forest institute in Kwara. Okay, so the guy, he taught me and he gave me a document, and that document is similar to what you are seeing here now. Okay. So, but that one, so like here, you see this that says 38.2 or 61.8. So if the market pulls back to 38.2 and run to 141.4, pulls back to 61.8 and run to 141.4, and then eventually pull back to 78.6, you have a cipher pattern in your hand. So this is the bullish, this is the bearish. So for each of them, you have the bullish and you have the bearish. This is crab. This is the bullish, this is the bearish. Okay. This is just a general information on the net. Okay. But now, if you come back to what we are doing, so MTI kind of, simplify what we do. Okay. And by calling it, if you say this is your A and this is your B, in between this your A to B, there's what we call sub A, sub B, sub C, sub D. Now, if you want to explain it in another concept, you will call it what's this guy's name? This wave theory. Okay, so you can explain it with the wave theory. Okay, and when you go to the wave theory, it's more even complicated. So the best way to understand it is what I want to show to you now. So when you have your A to your B, and then the market pulls back to C, what is important to you is that this pullback that this market pulls back, it didn't get to A. Do you understand? If the market goes A to B, and then the market now moves from B all the way coming back to A, but the market did not get to A, it's going to get to any of the Fibonacci level. It could be 78.6, it could be 61.8, it could be 50, anyone. Okay, when it gets to those Fibonacci level, these ratios are what we use to determine whether it's a Gartley pattern or it's a crab pattern or it's a butterfly pattern. Okay, so but now in this case, I'll just go straight to the first one. So this is Gartley pattern. So the condition for you to have a Gartley pattern is this. Okay, you have your sub AB at 61.8, sub BC at 61.8, and then sub CD at 1.27 or to 1 161.8. So this ranges from 61.8 to 78.6, and this ranges from 1.27 to 161.8. So this is what it means. Okay. So your market moves A to B. Usually, from our discussion, we said if the market move A to B, the next thing you want to do is for this market to go to D, right? But for this market to go to D, we said that if the market start pulling back, we should look for a candle reversal pattern, right? And when we see the candle reversal pattern, we will know that we have seen our C, okay? But now, there are many times that even though you see the C and the market start going back up, the market don't get to the B. And then you see another candle reversal pattern that says come down. Okay, so in that case, so this is a high, this is a low, this is a high, this is a low. So if the market forms a high, we know the market is going to move to form a low. If the market forms a low, we know it's going to move to form a high. But if this high is below this high, then the market has not succeeded in creating higher high. Okay, if the market succeeds in creating higher high, it means that the market is trending, right? But if the market failed in creating a high that is higher than this previous high, that market is probably going to range. Okay, but now in the attempt for the market to range, the market start creating this pattern. They are called harmonic patterns. So now what you want to do, what you want to achieve in Gartley pattern is when you measure your A to B, okay, this is your big A now to your big B. When you measure it with Fibonacci, you want to see that this candlestick pattern is coming from a 61.8 retracement level. Okay, if this pattern is coming from a 61.8 retracement level, it means that is condition number one established. Then this market now goes up. Okay, the market goes up. When the market goes up, this effectively has formed a sub A, sub B, and sub C, because this C did not get to the A. The same way we say this is A, this is B, and this is C, but this C did not get to the A. In the same vein, from this opposite side, you have A, you have B, you have C that didn't get to the A. And this measurement, we are saying that if this measurement here, A to B, gives us 61.8, this measurement A, B should also give us 61.8. Okay, and if this one gives us 61.8, when this market is extended, this sub A, sub B, sub C now, when it's extending, remember, this big one is going to create a price pattern. This small one is going to create a price pattern. This small one now is going to create A, B, C. This D, the D that is going to come from this small one should fall at the maximum 161.8. It could be 118, it could be 127, it could be one, but ideally for a Gartley pattern. So that's why sometimes we have patterns that are 100% perfectly formed and patterns that are not very well formed. But if you have this, trust me, if you have this 61.8, you measure this 61.8, and this comes down to 161.8. Then if you measure this and this your 161.8, this should be 78.6. When you have this condition fulfilled, then you have a Gartley pattern in your hand. I don't know. Okay, let me try to do it on a chart. Let me just go to either GBP USD or Euro USD, one of them. Let's see. GBP USD. So let's see GBP USD daily chart. Let's see Euro USD. I think it's better on Euro USD. Oh, okay. Okay, perfect. So let's look at So when you look at the chart, whenever you're looking at the chart, see what are some of the striking things that the market has done. Those are the things you're looking for. What are those things? What are some of those things that the market has done? So and when I finish explaining this thing, I will also show you why you need to be able to do this with some indicators on your chart. Okay, because now if you are looking at this chart like this, it's difficult to spot the patterns, right? The patterns on the chart. It's difficult to spot it. But then if you put some indicators on the chart, they might help you, in spotting it faster. Okay. So I'm seeing something here now. So let's take this one for instance. This is a high, this is a low. So this is your low, this is your A, this is your point here to here, is your impulsive move, right? So I can say this is your A, this is your B, and then this is your C. Okay, so let's put a line on this our C. Now the market gets to this C, eventually pulled back. I think this now become A, B, C. Okay. This is now A, B, C. And then this is your D. Okay. I want to show you why the market did this movement, right? So I'll just put the triangle. So if you pick the triangle and say this is your A, this is your B, this is your C. Okay. And then pick the triangle again and say this is your A, this is your A, B, this is your C, and then this is your D. So you have a pattern. This is an harmonic pattern. Now this pattern is why this market moved like this, and came all the way to the take profit right at the top. You see, it just came perfect all the way to this top, bam, and then it stopped. The market fell, right? So now this one, what we are saying, if it has to be any of the patterns that we are talking about now, we are saying that if I measure year to year, this guy, if it's going to be Gartley pattern, this guy should be in the neighborhood of 61.8, just like you have here now, right? 61.8. Then, if I measure year to year, okay, this guy should fall in the neighborhood of 61.8. But if you look at this one, this is not 61.8. See, 61.8 is far off. Okay, this is around 38.2, right? Yeah, about 38.2. Okay. And then what's the extension? Yeah, this extension is 127.2. Okay. But then this whole move from here to here came all the way to the 86 level. It dipped below the 78.6. So this pattern as it is, it's not a Gartley pattern. Okay. It's not a Gartley pattern. It's a pattern, yes, but you need to go and check. You need to come to all these ratios now and see which of this ratio that are on this patterns that fall, in the range that we have measured here. Okay, this is what you need to. So now I would just want to, because now you may not be able to get this thing 100%, right? You may not be able to say, okay, I measure it is exactly as it said in the book. It's exactly 61.8. It's exactly 61.8. I'm not saying that it's not possible. It happens. It takes a very long time, you know. Maybe you see an ideal situation, it can be one in months or one in even years. Okay. But then you are going to be seeing things that falls within the range. Okay, within that range, you can use them as your basis of selecting that this is the pattern that has formed. So this one that we're talking about now, as we speak, it's not falling into the category of Gartley pattern. Okay, but now I just want you to know that there's a pattern. A pattern has formed, right? And that pattern is responsible for this movement. Now, how will you see this pattern in real time? How will you see the pattern in real time? In order for you to see this pattern in real time, you need to be able to see that there was an impulsive move between this point and this point. You see this movement is a strong movement to the upside. Okay. And then this market now starts, we can say this is a pullback. Okay, or this is a counter move, against this impulsive move. But this counter move did not just come as a straight line like the impulsive move. You see, it came in wave. It came in A, B, C, D. So once you have A, B, C, D against an impulsive move, you have a pattern. That's the point I'm trying to make. Okay? When you have A, B, C, D against an impulsive, so the impulsive move has been established, and then you see the market doing its A, B, C, D, A, B, C, D against the impulsive move, then you have a pattern. I don't know if you guys are getting me. Is it clear? Is it clear to you guys?
So, question, just a question. This is Austin.
Yeah, Austin, go ahead.
So these patterns you talk about, what time frame do we have to look at?
It happens on all the time frames. It happens on all the time frames, but the one you see on higher time frames, they are stronger. So the pattern too can fail, right? Let me see if I can get something for you here. I used to have, okay. Okay, no
So it
problem.
means you have to go back.
As we progress, I'll
You
show
have
you.
to
But
go
now,
back
so
to
this is 4 hour, right? This time frame now is 4 hour. As you are seeing pattern on 4 hour, you will also see patterns on 1 hour. You will also see patterns on 30 minutes. But you see, the smaller the time frame, the more the patterns you will see.
Yeah, that's correct.
The smaller the time frame, the more the pattern you will see. The higher time frame, you will see patterns, but they are very rare. Very rare. And when you see them, they are usually very strong. Okay. So let me just see, let me just look for a pattern on any of the bigger time frame, any charts. I just want to see if I'll see a pattern here. So when the market is trending, you will not see all these patterns, okay? You only see the patterns when the market is ranging. Okay, that's when they start popping up, because the reality is when the market is trending, the market will be doing the ABCD that ABCD, ABCD, that's what you'll be seeing. But if the market is ranging, then you start seeing the market start moving in harmonics. Okay, so this harmonics is more like, how will I put it? Let me see, where will I use for you now? So if the market moves, uh, let's say from A to B, 100 pips. Let's see if we'll see something that is similar. Mm, the most popular one among them is the AB is equal to CD pattern. Okay. So the AB is equal to CD pattern is telling you that, okay, so let's take this one for instance. Look at this one. Let's say the market moves, from this point, see this point here, to this point, right? This point here. So this distance from here to here, let's measure it. So if we pick our cursor and put it here to here, This is what? This is 14798. Okay. So let's just say, yeah, say 1414148 or one, just approximately 150. Okay. Now, this market has done this move, done. And then it did all this move all the way to this point. Now, this move to this point is like an harmonic movement, okay? So if this move from year to year is also equivalent to 148 pips, look at it, we come here, look at it, perfect, 146. Can you see that? So this line, this move year to year, and this move year to year, both of them, you can call them as AB equal to CD pattern. Meaning, by the time the market move 150 pips here, and then the market retrace and move 150 pips here, the market will immediately reverse. This is what we call harmonics. So if the market move equal number of estimated amount of pips on two different occasions, they don't have to be, it mustn't be. So let's look at this one. So let's see, I think I see another one again. Look at this one. Look at this one now. If you say this one to this one, let's measure it from here. Sorry. Let's measure from here to here. Look at it. That's about 150 pips. Okay. And then the market did all this movement. And then the market now come here and fall another 150 pips from year to year. As soon as you see 150 pip or 148 pip, just take a buy because the market is going to reverse. This pattern is called AB is equal to CD pattern. Okay. In the same vein, it did it here. It did it here. Let's see what it's doing now. Okay, it has changed. Okay. Because the market can also come all the way to this area again, and then it will drop another 150 pips. So you can actually, you possibly would have, make some money from this third one. Because when he did this first one, did the second one, and he came back again and attended the third one, somebody can jump into the market and profit from there. Okay, or when he did this first one, did the second one, you would have bought the market from this second one all the way to this top and profit from there. Okay, so that's how to just understand how the pattern is. So Austin, your question, it occurs on all time frame. The only difference is that the ones that comes from the higher time frame, they have more weight, they have more accuracy, they are stronger, they are more reliable, okay, as compared to the ones that you see that pops up from a smaller time frame. So
Okay.
the essence is for you to know that even though the market is not trending, so the market did A, the market did B, and then the market did C, you would have thought that the market would go to D. Now, because the market did not go to D immediately, instead the market now did sub A, sub B, sub C, you start looking for a pattern. I had something similar like this on the GBP USD and Euro USD, but GBP USD has already broken its own. Let me see GBP USD and Euro USD. GBP USD already broken its own, but I think Euro USD own is still in force. Let's see. Yeah, look at it. Euro USD, look at it. This is your starting point. This is your impulsive move, right? The market came down. Okay. And then the market did this push all the way back, right? It came back all the way back to this point. So we would have said this is A, this is B, this is C, and then market wants to sell, right? But then in an attempt to sell, the market did not sell. Instead, the market create a smaller pattern even inside this pattern. So this move here, A, so usually this will be called X, okay? If you go by the normal convention of naming harmonic pattern, this is your X, and then you start counting your A, B, C, D here. So this is your X, this is your A, this is your B, this is your C, this is your D. Okay, but inside this your A, this your A to this your D, we still have a smaller pattern here. So this is a big pattern. Watch this. This is your X. This is your A. This is your, sorry, I made a mistake. Let me take it again. So this is your X. This is your A. This is your B. Okay. And then you pick your B. This is your C. And then this is your D. So this is your pattern, right? Now, this is your main pattern now that is formed like this. I'm telling you that even inside this pattern, there is also a pattern inside. Look at the pattern here. This is your X. This is your A. This is your B, right? And then you now have your B, your C, and your D. This is what drove the market to this point now. That is giving you the bigger pattern, the bigger picture. So this is a small pattern inside this big pattern that is forming. The big pattern is just forming now. Okay, this is a big pattern. This is your X, this is your A, this is your B, this is your C, and then this is your D. So this market is meant to now fall down, right? So usually if this market fall down, it's going to come to somewhere either here or here, for the market to continue its bullish move. Okay, so, but in GBP USD, this pattern has been invalidated. So look at GBP USD. It's still the same pattern that was forming, just like you have for Euro USD, but the one of GBP USD, it has taken out this high. Okay, so let me not say it's completely invalidated anyway, because sometimes you have the pattern that goes above the eye and then come back into the AB boundary and still form the pattern. Okay, so meaning that there's a possibility that GBP USD can fall down, okay, all the way to any of this high here, or any of this low here, and then it now continues is massive buy that intended to buy. Okay, so now if you look at it now, even though the market is going up or the market is going down, it's doing all this by creating harmonic patterns. Harmonic pattern. If you take your time to look at the chart very well, okay, you will see harmonic patterns everywhere. There are a lot of them, okay, on the chart. So what I will normally do for me to identify it faster is I will put an indicator on the chart. So that indicator help me to tell. So for instance, let's just look at this again. So we say this is Gartley pattern, right? And then the next one is our BAT pattern. So these are the ratio for BAT pattern, okay? So your BAT pattern is you see this time, instead of 61.8, market came to 38.2, between 38.2 and 50, and then run from here to 61.8, between 61.8 and 86, okay? And then drops down. In fact, it went, this time now, it's not just 161.8. See, it went below 161.8. But then, if you look at the big picture here, it's not below 86. In some other people will call it 88.6. So once you have, this range, you need to take note of the range. If you look at this diagram and look at this place that is colored, okay, this is the range. So it's between 161.8 and 261.8. So meaning that this reversal can come between this area. In the same vein here, this one is between 61.8 and 80 and 0. Okay, it means this reversal can come from this area. Okay, and then when you see this reversal here, you can confidently say that a bat pattern has been formed. Okay, and you can trade it. So usually the high is your first take profit. Okay, and then you now put your Fibonacci and extend to the extension of this 81.6, which is usually 1.18. Okay, that will be your final take profit. Okay, so that's for your BAT. In the same vein, you do it for Cypher. So Cypher, you see the market go off the eye. You see, the market comes here, get to either 38.2 or 50 or 61.8, and then the market runs, goes beyond the high. Now you would have think in your mind, you would have said, okay, this market is now going to D. But remember, the D that is, the D that line up with 38.2 and 61.8 is 161.8. And this market has not gotten there. And all of a sudden, the market developed a high. And you see that I pushed the market back into this AB boundary. When it comes back into this AB boundary for a cipher pattern, we are saying that why this is going to pull back, it shouldn't go below the 78.6 level. 78.6. If it didn't go below 78.6 and they met this condition, and met this condition, this gives you what we call a cipher pattern. So this one from here, so when the market runs from here, when the market pulls back to this and find its way to either 1.18 or 1.27 level, which we know it hasn't gotten to your 161.8. This market will develop a high, run back into the boundary, gets to 78.6, and then if you see a candlestick formation here, you're sure that a cipher pattern has been formed. This is one of the conditions where you see that the market blow past the B of the AB and then pulls back into the AB boundary. Okay, that's for cipher pattern. Then butterfly pattern. Okay, so butterfly pattern, similar to cipher pattern. In this case, instead of the market to go past B, the market will go below A, for it to form butterfly. So you have your A, you have your B, and then your sub A, sub B goes below the A. That is extending all the way to around 1.27, between 1.27 and 161.8. So this is your A, this is your B. This is between 38.2 and 50 retracement level, and extension to 1.27 and 161.8. So all these figures, so for me, the two critical ones are this one, three critical figures. This figure, and these figures. These are the three critical figures. So let's go back to the previous one and let's see what we're talking about. So yeah, okay, so here you have this figure, and this figure. These are your critical figure. So market, in the first instance, retracement is between 38.2 and 61.8. Extension is between 1.18 and 1.27. And then retracement here is 78.6. You have a cipher pattern, right? A cipher pattern. Okay. Well, then if you come to butterfly, retracement, your first retracement is between 38.2 and 50. And your second retracement is between 38.2 and 50. Then your extension here is 1.27 and 1.618. You have a butterfly pattern. Okay. Now let's go and see that for Gartley pattern. So that's more like the shortcut. Okay. So for Gartley pattern, you are looking at retracement to 61.8, retracement to 61.8. I want you to look at this very carefully. This is the most occurring pattern in the forex market. This is the best pattern you can ever find in the forex market. Okay. And your three key values are first retracement 61.8, second retracement 61.8, third retracement is 78.6, or this your extension is 161.8. This is perfect. Whenever you get this is a perfect Gartley pattern. And whenever you see it, the market will run like crazy. The market will run like crazy. This is the easiest. Are you seeing that this one, there's no range? There's no or. This is 61.8 is compulsory. This is 61.8 is compulsory. This is 78.6 is compulsory. There's no or. And this your 161.8 is compulsory. Once you see this in the market, there are people that will only trade this pattern, as in no matter what happened, they will not trade any other thing until they see this pattern. Okay. And imagine that you have all this asset to select from, right? And in a week, you are able to see just one Gartley pattern. Let's even say that in a month, you are able to see one Gartley pattern. And that one Gartley pattern, you trade it with all of your mind. One Gartley pattern. Trade it with all of your mind, with all the lots that you have. Remember, when you are trading it, you will make sure that your stop loss is below this A. So as soon as this market comes A, B, C, D, and this is 1.618, just measure A to B. If it is 78.6, a Gartley pattern has formed. Perfect Gartley pattern. That's when you want to take your trade. Look for a candlestick formation in this area and take your trade. And as you're taking your trade, your stop loss should be below the A. Your take profit is going to be at 1.27, which is the corresponding extension to 78.6. 1.27. That will be your take profit. Is it clear to everybody?
So a quick one, eh? So when you join your Fibonacci
Yeah.
to establish these patterns, so you are going to draw from the left to the right. Let's say from A to B.
No. It's so if you are so your pattern can be either bullish pattern or bearish pattern. What we've talked about so far is bullish pattern. The opposite,
Mm.
which is what you see now, this is the bearish pattern. Okay, this is the bearish of the Gartley. Okay, this is the bearish of the bat. Okay, so but now all these figures I'm telling you, you need to. I will drop this material on the WhatsApp for all of you. Okay, go and memorize these values. Memorize them. But like I said, if you look at this one, look at this Gartley. See this Gartley. Okay, see this bat. Okay, these key values, you need to know them. Now, what I'm explaining to you now, if you go to the one I brought from Google, okay, and you want to look at it, this one is a little bit confusing, okay, because they tell you to measure X, A, B, B, C, which is similar to what we are explaining, but it's a lot easier, from what we have here. Okay, it's a lot easier from what we're explaining here. Okay, so now one way I do it is I can just look for a arrow signal. Let's take something like this and put on my chart. Let's put this arrow on my chart, right? Now with this arrow on my chart, see the way I will look for my pattern. Okay. So this is more like a cipher pattern. This move here, it's like a cipher pattern. Remember cipher pattern, it will go out of your B. This is your A, this is your B. So let me mark it. This is your A, this is your B, right? This is your B, and then this is your A, this is your extension, right? This from here to here, this is the extension, and then pulled back into, so this is your like A, B, C, D. But then this is not really C, right? Because it's an extension of this move. So if I pick this, yeah, this is my A, this is my B, and then this is my C. Okay. And then I pick this, and this. So this is a cipher pattern. If you look at it, why is it a cipher pattern? Because this market pulls out of this. If you come to your this, look at your conditions. Okay. So we say this is, look at cipher pattern. This is cipher pattern. Look at your cipher pattern, right? So you see your cipher pattern, your A to your B, you will see that your next C is out of your B, which is the perfect example that you have here. Now, this is your A, this is your B. You see this C is out of your B. Now, can you see how easy? I don't need to think. I don't need to rehearse. All I need is I see this is my A, and I see this market come back into my AB boundary with sub A, sub B, sub C, sub D. Capish? And even this movement of this your sub B here, this your sub B here, it's also a pattern of its own. So let's remove this. Let's remove this. B object. Okay. Remove this. We can say this is your A. Look at it. This is your A. Okay. And then this is your B. So this is your B. We also have your A, your B, your C, your D. This is sub A, sub B, sub C, sub D for you to sell this one. And then you will now come and have the other pattern for you to buy this one. Okay. So if I want to put that, I pick my triangle. So this is my A, X, this is my A, this is my B. Okay. I pick my triangle again. Pick this, pick this, pick this. So this is a pattern that pushes this market down here. Okay. So what I'm trying to tell you is this. This pattern, you may not need to break your head with the measurement. You may not need to struggle with the measurement. Just put a arrow signal like this on your chart, and you can see this pattern. I don't know if it's making sense to you guys. You can see this pattern form. Let me look for one perfect one. Okay. Let's see if I'll see any perfect one here. Now remember, because I'm using the big size of the arrow, right? Use the big size of the arrow. So the patterns I will see will be few. And if I switch to a smaller time frame, I will also see more patterns. So if I come here, okay, you can already see a pattern here, right? This is your impulsive move. This is your A, this is your B, this is your C, this is your D, you know, and then you can now come again that this is your C, this is your D. Okay. So this one to the same thing. So anytime you see, so one way you can do is uh anytime you, so for instance, now if I see this arrow, this A, B, C, D. Once I see this 4 arrow like this, what I will do, I can simply just put a line here and go and look for the next arrow that is below that line, which is this one now, okay? Or this one. You understand? So the lowest, let's say the lowest arrow here. This is a very big, okay, so let's do something. Let's mark here, okay, and switch this chart to a, this is 1 hour, let's switch it to 4 hour, okay, 4 hour. Can I see the place that I mark? No, it will be difficult for me to see it. I can't see it. Okay, no problem. So let's see daily. Can see daily too. Yeah, so if you look at daily now, this is GBP USD. So this is A. Sorry, this is X. This is your X. This is your, right? So we can now come and say this is your A, this is your B, this is your C, and this is your D, right? Now, this may not be the end of this arrow because this market can still push it forward, right? So anywhere this market push it to, anywhere at all it pushes it to before it stops, right? You can use that as your D. So this is your X, sub A, sub B, sub C, sub D, and then the market will fall. Okay. Is it clear to everybody? So this is the fastest way for you to see it. Now, when you now see it, you cannot decide to do the measurement. Or if you have an indicator, I have an indicator that shows me pattern. So let's see, let's look at that indicator. What's the name of that indicator again? I have up to like 2 or 3 pattern indicators. Markets. Harmonic pattern. Okay. So this one is 1. This one is 1. So if I pull this one like this, I just put it on the chart. So this one gives me all the different type of pattern. Like, I talked about AB is equal to CD, right? So this is A, B, this is C, D. Meaning that the total number of pips here and the total number of pips here, they are almost equal. So let's measure it. So if we come here and say year to year, that's 6038. Okay, so let's measure year to year. You see, 627. So they are almost equal. So this makes it AB is equal to CD pattern. And this is why this market dropped all these pips down. So with this indicator, if you are taking this from here, you would have put your stop loss above any of these places, here, here, or here. So now it's telling you that this market cannot actually either sell from here, or sell from here, or sell from here. And good and fine, it sold from the first one, and the market came down. Okay, let's see if I have any other pattern displayed there. So, yeah, so if you want to see more pattern, you can just come here and change the number of bars. So if I say display 5,000 bars for me, as against 1,000, I will see more. Okay, so it will give you a list. Usually, it will give you a list of what you are seeing here. Let me bring this. Let me remove this from this so that you can see it. So it will give you a list. So yeah, I have how many patterns? I have 1, 2, 3, 4. Okay, so the ABCD bullish are 4, ABCD bearish 5, 1 plus ABCD bearish 3, and crab pattern. So if I start scrolling this chart back now, I will see all those patterns. These are past patterns that has happened in the past. You see them. Okay. And if you change this chart, you change it to any currency pair to just give you the pattern that is there. Okay. So you will see what the market is doing, per time. Okay, so this one is 1. Now, if you try the other one, so usually because of accuracy, I just try to manage what I use there. So let's see this one. This one is, let me change this to, uh, 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 this is white background, connect to false. Okay, so I say, okay. So this one gives you all the different type of pattern. They are mush. Okay. So at every point in the market, it gives you a pattern every point. So the all the pattern, it's not all of them that are, very effective, but at least a good number of them are effective, most especially if you are taking it from the daily chart. Okay. So if I want to see the previous pattern that has happened, it's just for me to come here and click. So as you are clicking, you see all the pattern that has happened in the past. Okay. And you see how well they work. So see like this one now. See like this pattern. See this pattern sold the market very well. Okay. So if you keep going, see this one. This one bought the market very well. Okay. And this one will give you the stop loss and also gives you the take profit. Okay. So this is one way that you can identify. We have a lot of indicators out there, free indicators that you can use to check. Now, normally when you see like this, what you can do is to want to on your own measure whether is correct. Okay. If it's not correct, it's up to you whether you want to take it or you don't want to take it. Okay. It's just a thing of choice. So that's how you, and so those are the two ways, that I think is easier for you to identify the pattern. All right. Any question? Okay.
So these patterns can be called up. You don't have to do any setting. So any setting on the pattern, or you just call them up.
No, so if you understand what I explain here, you can physically see them. So if you want to do the work, right? You really want to do the work of identifying the pattern. This is your chart. Your chart is just moving, naturally. The market is moving naturally. So it's up to you to now identify the patterns that the market is creating. Do you understand? You as a trader,
Yeah.
it's your duty to now identify what are the pattern that this market is creating for you. Okay. Once you're able to identify that, then it's easy. You can take your trade, set your stop loss, take your profit.
Okay. Sounds good. Thanks.
All right. So general question. Anybody have any question? You want to clarify something? You want to analyze the chart? You're confused about something? Let me know. Are we all good? No challenge. Tomorrow we're going to be making the dollars. Are we going to be seeing pips tomorrow? Okay, so how many of you remember? How many of you remember the last time when I talked about my trading strategy? I told you what you need to look out for, okay, to take the trade. I know most of you normally see this, right? When I post this, I'm sure you, when I post things like this, you see them, right? Mr. George, I think like your network is really bad. It's not able to join. Okay, so what you see on your screen is all the time frame, monthly, weekly, daily, 4 hour, 1 hour. Okay. Now, I want you to look at this monthly, look at this weekly, and then you can now come and look at this 1 hour and 4 hour. Okay. I want you to know that these two guys, this monthly and this weekly, they drive the market, in their direction. They drive the market down. They push the market up. Okay. So the last time I did showed you my personal strategy. And I told you that the market will sell from the rear, that's the back of the candle that creates that stop. Okay. So if you look at this weekly chart, for instance, this market created a high here. So let's just call it double top. It created a double top here. And then the market started falling. So the market fell and it gets to this point where it creates the first bearish candle that is immediately followed by a bullish candle. I said, this is your stop. This your bearish candle followed by a bullish candle is your stop. How many of us remember? I said, this is your actual resistance or support. So this place here, this is your I and I, this is resistance, right? And then the market came down and for the first time created a support here. I said, go to the rear of the bearish candlestick. So if you look at the bearish candlestick and the bullish candlestick, I have Akiashi on them. And the Akiashi on the bearish candlestick is higher than the Akiashi on the bullish candlestick. I said, go to the back of this bearish Akiashi candlestick. I said, this point, this level is your sell. Take your sell here, enter the trade from here, sell, and put your stop loss above this place. Now, can you see this weekly chart, how it nicely fell down, coming down slowly, 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 slowly. Can you see that? Neatly. Now, but you see this move here on this daily, this 1 hour, this 4 hour, it's scattered. Okay. So what you naturally will do is to either have an indicator that tells you, oh, this market starts selling from here. So I want to be buying continuation trade on the lower time frame. So whenever I see that on the lower time frame, the market pulls back, I put a counter trend line across this place like this. So I come here, put a counter trend line here, and then the market breaks it, and I say sell. Okay. This thing that you are seeing here Now be this. Sorry. Look at it here. Now be this. This is it on the 4 hour. This is it on the 1 hour. Okay. And if you come to the daily, look at it here. Is this place here? This small place here. Look at it on the daily. On the weekly, you may not be able to see it. On the monthly, you may not be able to see it. Okay. But now, because you know that the market from the high came down, gave the first stop, pull back to the rear of the bearish Ikianshi, and I said the market starts selling from there. So what you want to do, all you want to do is to take set trade. Your action is to take set trade. So you see that you are looking at the daily time frame and selling, continuation, or you are looking at the 4 hour time frame and you are selling continuation. So when you see this continuation, you sell. Okay. You see the continuation here, you sell. You see the continuation here, you sell. Okay. That's the way it works. Okay, so your monthly, if you look at your monthly, this high, this double top that you are seeing here now, is actually this candle, right? This candle and this candle that form this double top that you are seeing here. Okay, so you want to make sure that you are selling in the direction of the monthly. So the monthly here, this, when you see bearish followed by bullish, it means the market is buying, right? So what you want to do, you want to buy counter trend line break positive, okay? Counter trend line that breaks in the direction of the buy, you want to buy. In the same vein, yeah, you want to sell. Okay, I want to sell because I'm seeing that the market has done a bullish candle that is immediately followed by a bearish candle. But now, for me to sell, I need this condition. I need to see this condition. I won't see it on the weekly. I won't see it on the monthly because the monthly will take a lot of time for this thing to develop. Now, if you look at the monthly, up till now, there is no bullish candlestick. Up till now, from when the market started falling, there's no bullish candlestick. But if you look at the weekly, we've had 1-2 pullback, we have another 1-2 pullback, and then we have another one that's currently setting up again. Okay. I don't know if this explanation makes sense to you guys. Does it?
Yeah, it's fine. I want to ask a question, sir.
Right.
From the last class I just finished right now on the Fibonacci level, you said something about 61.8 going
Yeah.
to 1.27. Is that always a norm?
Yeah. So we, in our previous class, we already established that, right? So let me see if I have it here. Okay, yeah. So look at this. If the market pulls back to blue, okay, if it pulls back to green, are you seeing green? Yeah, it will extend to green. If it pulls back to blue, it will extend to blue. If it pulls back to red, now if you look at this case, there are three red. That is 38.2, 50, and 61.8. So anytime the market retraces to any of these three, it will move to 161.8. Yes, that's the golden ratio. 61.8 is called the golden Fibonacci ratio in the whole world. Okay, and if the market retraces to 61.8 level and then it finds, a reason to continue to move, it will naturally move to 161.8 level. And that's why the banks can confidently trade this market with this Fibonacci tool. Because it is very, very correct.
Thank you.
Actually. So you can actually come here, you can actually come to the weekly, okay, put your Fibonacci on the weekly, and then you now go to the daily and allow the market to go until it gets to the Fibonacci of the weekly as your take profit. Do you understand? So I might come here now and say, okay, I'm looking to trade this market. Let me zoom it down a little bit. Okay, I'm looking to trade this market. All right. And then this market did this. This is your A, this is your B, and then this is your C. So the market, if I put Fibonacci between here and here, okay, so the market came to, look at it, the market came to 86, right? It came to 86 level. Look at this drop from this 86 level. This market, if you go back to what I just showed you, if the market comes to 86 level, the market will move to 1.18, which is green. Look at this market now, this market that has happened in the past. This market came down, pulls back to the 86 level. This is the 86 level, right? And then look at where it came to. Look at it. This is the 1.18 level. Look at it. So when it came down from here, it will come to 1.18. When it gets there, you will see that it's going to quickly do a pullback. Look at it. Came here, 100%. Okay. Now, look at this one that we just talked about now. AB is equal to CD. The market dropped from this point to this point. Okay. So let's say that is how many pips. So we measure from here to here. Say this is 741 pips. Now the market pulls back and then it dropped again. It has created that same amount of pip it created before. 720, this one is 725. Okay. So this is AB is equal to CD pattern. So what the market will do next from here is that the market will buy. Okay. So all this is you have to look at it. You have to look at it, and be able to tell or make the decision of taking that trade. It's very important. You need to be sure that what you are looking at is correct, and you are able to use it. So look at this now. So this movement to this point and this movement to this point, they are equal. So whenever you have AB is equal to CD, the market is going to buy. That's what is going to happen to this market. Okay.
Thank you very much.
Okay. Any other question? Any other person? So I've looked at this market carefully, and like I said, and the way I explained also in my last class, whenever the market, move from support to resistance, and then that very candle that defines the resistance or that very candle that defines the support, that's where the market moves from. Which is this example I'm giving to you now. This movement from resistance to support. The rear of this candle is where the market moves from, the rear. If you look at this one, this is support to resistance. The rear of this candle, these two candles, this is where the market moves from. Look at this one now. This one is moving from support to resistance. The rear of this is where the market will take off from. See, it's so accurate. I don't know if you guys are seeing what I'm saying. It's so accurate. If you take your time, look at it very well, you see that it's very, very accurate and powerful. How do you explain? Okay, look at this one. How do you explain to me that this market, this is resistance, then the market came down, this is black, 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 and then boom, this is green, right? So between these two, I say this is my support, okay? I said the rear of these two candles, go there and put a line at this point, put a line at this point. This space here is where the market will drop from. This space. Are you seeing the sell that market sold from there? Can you see that? This explanation, is it clear to you guys? I want to be sure that it's clear. Because if you apply this thing very well, trust me, you will make money.
So this is mostly on the low time frame now, 1 hour.
No, what I'm showing you is weekly now. This is weekly time frame.
Weekly.
Yes,
Okay.
I'm explaining to you is weekly time frame. I'm telling you
Sorry,
that if
God.
you can see it on weekly time frame, if you see it on
Mm.
weekly time frame, man, these two guys from daily to 1 hour, they don't have control over the week. The week senior all of them. They will follow the direction, no matter how they wave, no matter how they swing. Okay, let me show you BTC USD. Let me show you that BTC USD. I've not closed it because it's a demo account. This. Got this.
Because if you are working on weekly, it takes time for these things to form.
No, so this is weekly now. This is weekly, right? And then this is 1 hour. So this market has actually gone all the way to 100 and something pips. It's just that it pulls back now. Maybe before they will break now, this thing will go higher up. Okay. Now, see this market. This market has falling, 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 falling. And look at what I'm looking at. Look at this weekly. Are you seeing this? Are you seeing this market that move, bam, 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 bam? Then it formed this bullish candle and this bearish candle. I said the bottom of this bullish candle is your reference point to buy. When the market gets here, when the market did all this move and came back to this place, we expect the market to come and break this counter trend line to buy. If you look at it on the monthly, you see monthly, this is it. In monthly, you have it here. You have it here, here. Okay, and here. See the monthly, number one, first, this was the rejection. Secondly, this was the rejection. Now it's also creating another rejection. The next thing you see is that this market will come and break this counter trend line. If the market breaks this counter trend line, that's a massive run. All this movement that you're seeing here now, that's what you're seeing here in this weekly that is like this, that is scattered like this. Look at it on the monthly. It's just 1, 2, 3, 4, 5, 6, 7 candles. 7 candles. This is 7 months of this market doing this nonsense here. Okay. These 7 months, you are washing. Then another way I can explain it to you is anytime you see that the market comes back to, let's say the market gets here and the market didn't stop, the market break here. Your next level of washing is here. You come down here and here. When if the market did not break here and buy, it comes here, there's a tendency that it will break here and buy. So you just look for your trade to be very effective, you are looking at the big time frame. Okay? You're looking at the big time frame to make that decision. And this year I'm telling you, trust me. Okay, see, okay, let me give you an example here. Look at this weekly chart. Look at this weekly chart. This market forms this. Look at it. The market forms, let's take from this low. Okay. The market formed this low. Initially, first of all, formed this high and it continue, and then it formed this high and it continue, and then it formed this high. Now, after forming this high, it attempts to range. The whole of this is nice, a range. Look at it. All these are range. But this is your range. This is your mark between these 2 points. And then the market gives you a doji from this point. Immediately after the doji was preceded by a bullish candle. This is where you will put your buy. You can even buy it from the doji. Just because it's still on a red Akihashi, you may want to wait and buy it from this one. You put this buy here, and this market run like this. If you wait for the market to break, maybe you'll be taking the trade from here, which is very high. But even at that, the market still run up. You understand? Now, I'm telling you, the next one now is where we are now, this one. After this one, the next one is this one. Yeah. So you just wait for the market to come back here, or wait for the market to come back here and here. Look at it here and here. Okay. Now the market has actually come back here. You see the market came down. Imagine this candle coming down all the way and coming to close here. That's a strong rejection. This is a powerful rejection.
Mm.
Okay? It tells you that this area, and now look at it, I have rejection here. How many candlesticks are rejected this area? 1, 2, 3, 4. And this candlestick that is currently forming, can't you see that it's a bullish engulfing candle? This candle is going to close by 1 a.m. this night. Another candle will start because this is weekly candle. 1 a.m. this night, a new candle will open. Now that new candle will just come and run up.
Sorry, sir.
Yeah.
Can you change your candles color to just 2 colors so that we'll get it better? We have different colors around.
So my colors, they are actually 2 colors, okay? And if I change it the way you want, I'm going to show you now. I want to show you what you want now. Okay. What you want now, look at it. This is the candle. This somewhat green and black. These are the real candles. So if I do like this, if I put it like this, 1, 2, 3, 4, these are the real candle. These are just the 2 colors. Okay. But if I use these 2 colors, I will be wrong. The reason is that the Akianshi is the most powerful trend confirming tool in the whole world. Akianshi candlestick. So that's why I need to put Akianshi, because Akianshi gives me a true reflection. So if I put this Akianshi on my chart, I can decide to say, I want to make the Akianshi the same color with the candlestick, which is what you are saying, right? I can decide to say, let this Akianshi be this color. So instead of this, I can come here and I say this. I change the color to okay, and I change this one to black. Okay. Then I can remove this clone because this even if I change that, it will not change. You see that? Okay, so let me do one more thing. Look at the clone I can change. All right. So look at it now. So this is both the Aikiashi and the candle are not the same color, right? So instead of me seeing my candle as ending here, Okay, if I remove, I can remove the week, right? Let me just do something. Let's remove the week. Let's remove the week. Just now, we're not going to have week, but I'm sure you understand. So if I remove the week like this, right? I will now be looking at anytime I see this is all the way green, right? And then this is black. So anytime I see black following green, I will look at this place. So my reference is here. So from here, I'm looking at a bullish candlestick formation for me to buy. Do you understand? If you look at this one, this previous one, I'm looking for a bullish candlestick to buy. Now, the problem with this is that if you are not seeing the wick, you may not see the rejections. And that rejection is very important, for you to make your decision. If you're just seeing only the candle like this, you probably it will be more difficult for you to know which place is the rejection coming from. Why am I buying or why am I selling? It may be more difficult. But like this, of course, I've tried this before, but I really don't like it. So I prefer this. Okay. The beauty of this is that I know that this is the candle and I know that this is the Aikianshi. Do you understand? And let me also give you another idea about Aikianshi. Remember, you see your candle, your candles are haphazard, okay? You can open higher, they can open lower, it doesn't matter. But you see this Aikianshi will always open from 50% of the previous one. 50%. If I take out the candle, you see only the Aikianshi. The Aikianshi alone is a candlestick. You understand? So if you look at each of these Aikianshi, no matter how small, no matter how big, the next one open from 50% of the previous one. This one open from 50% of this. This one open from 50% of this. This one open from. So in that way, it gives you a better trend. So anytime you see that Aikianshi, you see that this Aikianshi has closed below this Aikianshi. Now, even though it's closing below this Aikianshi, in reality for the candles, it's not correct. It doesn't mean that if the Aikianshi closes below the next Aikianshi, that means the actual candle has also closed. It's not like that. Okay? But then the Aikianshi has a higher strength to control the direction that the market will go as compared to the normal candlestick. Okay? And if you see, maybe you may be having multiples of buy, sell, like in this place now that I see only blue now. That doesn't mean that there are no black candle here. That doesn't mean that there are no bearish candle. There are bearish candle, but IKEA is telling you that this market is a buy. If you put the candle there now, you see that there's a bearish candle here, there's a bearish candle here, there's a bearish candle here. But if you remove all that, you see that everything is blue. IKEA telling you the market is what? Is a buy. Okay. I don't know if that makes sense to you.
So I guess I can answer from the MP4 now.
You see?
I will get Akianshi candle from the call it up from MT4 on MT4.
No, you need to just go to Google and type Aikiashi candlestick. You will see it. If you go to Google,
Okay.
just type Aikiashi. Heiken Aikiashi candlestick. Or just Aikiashi.
So my question is, how do I get it on my chart?
That's what I want to show to you now. I can actually indicator. Okay. So when you come here and say, okay, you see a lot, right? So you just, let's say you pick this one from C market or anyone, you can pick anyone. Okay. Anyone you pick, it will give you a file. Okay. So let's pick this one for instance. Let's look for the file. So on this site, you have to register before you can download from them, okay? We'll check another one. This one is not giving me what I want. Investopedia. Okay, let's just see. Okay, so let's see this one now. This one say free IKN sheet. Okay, so this one they have different indicators. So when you look for it like this, so yeah, you see available for MT4. Okay, you say download. So if you click on this download now, for instance, okay, and say download, now it has downloaded. You come to your download, compress. This is it, Ikianshi. So if I click on this now, this is the file, Calify Ikianshi. You will copy this file. Austin, can you hear me? You copy this file, okay? And then you come to your MT4. On your MT4, you will click on file. You click on open data folder, okay? In your data folder open, you go to MQL4. Click on MQL4, go to indicator, click on indicators, come here and paste. Right click and paste. Okay, that's it, Ikianshi. So now once you paste, you come here and you will close this your MT4. Okay, when you close the MT4, open the MT4 again. By the time you open the MT4 again, the Ikianshi would have been fully installed. Okay, so when you click on your navigator, click on navigator, and then remember the name of the file, Ikianshi, right? So we can just type HE. Look at it, Ikianshi. Okay, so that's the file. So if you come here, let me open this one and say this time I put plain. This is plain chart without Ikianshi, right? Then I'll now come here and I'll say, where's the Ikianshi? This one. I say double click on it. Okay. And say okay. So that's your Ikianshi there. That's how you attach it to the chart. So any one of them, this one, still the same thing. Yeah, same thing. Okay. So the who is there? This one, the reason why I don't like this one is that most time when I expand like this, it doesn't expand. Okay, even if you come and expand it, if you come and expand it, by the time you switch, sorry, expand, let me try the see, it doesn't even expand. So this one usually does not expand. So there's one that I use that is called Hammer 2. This one. So this one, this is how it come originally. Okay. But now I will now have to change this period to 1 in order for it to give me what I want. So when I change the period to 1, okay, you see how it is now. So it's now showing the way I want. And this one, I can expand it. Okay. I can come and say, I want the width to be 13. And it will expand. You see that? So if I zoom it wider, you see that it tallies. If I want to use at this level, and I want the width to tally, all I need to do is to change this 13 to 6. Okay. And then it will tally with my candle. Are you seeing that? Okay. So you have a lot of it. If you go to MQL4, that is the people that provide the MetaTrader 4. This is their website. I've shown you guys all these things before. You come here, MQL5. Okay. So yeah, if you come to market, you have MT5 indicators, MT4 indicators. So if you click on MT4 indicators, you can just come here. From here, you can just download it. So you can say, you can type actually, okay, and select. So it bring out all the Aiki that they have for you. This one is paid. This one is $80. You have to buy this to use this. But this one is free. This one is free. These ones are free. Okay, all this free one you can easily okay. This one is not free. This one is $30. Or you can just come here, click on free, and it will show you only the free one. If you click on paid, it will show you all the ones that you need to pay for. Okay. Let me see this one that is $80. Let me see how well it does perform. Okay. Okay, another time. Okay, so you can, before you buy indicator, you can come here and check the comment, check the review, check what people are saying about the indicator, if it's nice, and then you can buy it. Okay. So for this one, it's not free. You have to pay. But if you want the free one, like I already showed you, you can go to you can come and click on free, and it will show you all the free ones. Now, and this is based on what you select here, right? So if I just select Aiki like this, look for free one, there's none. Sorry. And delete this. SAHEI. See again. So there's nothing here. Now you can do that for MT4, you can do that for MT5, all the indicators you need. If you need free, just come here, click free so that it will show you only free. Everything here is free. And once it says free like this, now you can easily just come here and click on. So if you click on the indicator, say like this, you can come here, say download. Once I say download now like this, it will ask me which platform do I want to download it to. This one is MT5. So I just click on yes, I have MT5. It will automatically open my MT5 and put the indicator inside automatically. Okay. So if you don't have an account, you can create an account. Me, I already have an account, so I just go. So I say login. So if I go back there again and I say download again, go to my MT5, it will just come. Now when it's installed, you will see, now you can see that it has supply and demand order block. So now if I now go to a chart, let's say chart here, and I say supply and demand order block, I just click on it and say okay. And then it applies. You see that it applies to my chart. So it's telling you that this is an order block. So if the market comes back to this place, expect a sell. This is an order block. Okay. It shows you the order blocks in the market, based on the currency pair that you are trading. Let's see. Let's see another currency pair and see what it's going to give to us. Say Euro US. Now you see other blocks. See this one. 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 So all this place that is putting order block now is telling you that if the market comes back to this place, there's a tendency that either the market will break the order block, that is the other block will fail, or the other block will buy. See this one. This is an order block. The market came very close to it before pulling back. Okay. So that's how you install indicators on your chart. It's not rocket science. It's very
Yeah,
easy.
right,
Very
right.
easy. So it's either you pick from the market direct, or you go to a site, download from the site, copy it and come and paste it in your folder. Any of the ways works, and you get the same result. Okay. All right. Are we together? It's 10 o'clock. So how many of us have been able to create their own trading system? You see all this that I'm doing now, all this I'm doing, I've also been able to create my own trading system, right? Where I don't need to waste too much time analyzing the chart. So I just wait for the chart to give me, so let me see. Let me give you an example. So let's take, so let me use US dollar for instance. US dollar. So US dollar. Yeah, that reminds me, there's an important concept I need to explain. Okay, let me just show you this and I explain that before we close. So this is H4. Let me pull this out. Okay, just pick H4. So this is H4. All right. So now this is a system, right? And this system works with conditions that I set. Okay. So can you see this blue line? This blue line. This one, this navy blue line. So if you look at this navy blue line, you will see that after the market formed this navy blue line, it has formed this steel blue resistance, and this T blue support that did not get to the navy blue. Okay, so this first T blue that is at the level of the navy blue is my A. This second T blue is my B, and this third C blue is my C, right? Now, that's step one. So my first condition is I want to see the maroon red, steel blue 1, steel blue 2, steel blue 3 as my condition. That's my first condition. Okay. That's the first condition I want to see. Now, after I see that condition, the next thing I want to see is I want to look back. When I look back, in this case, I have a steel blue support here. So the market came to this, my steel blue is coming from a previous level of support. Okay, that's condition number 2. Then another condition is I'm going to draw a trend line, okay, from the high of this first steel blue until this market gets to this steel blue and then break. When this market break this steel blue, break this trend line, my entry could be aggressive by just buying, the break of the trend line, or I can wait and put a line. Remember my Akianshi, right? Put a line on top of this. This is the black candle, and this is the green candle. Okay, put horizontal line on these two. If the market comes into this area, okay, that is where I'll take my buy. So I buy the market here, but my stop loss must be below this navy blue. So if you put Fibonacci there from this to this, you see that this guy came to 78.6 level. So this market, as a matter of fact, will go minimum 127.2, this area, to take profit. Okay. So this market go to this level. So on this one move, that's about $4.6 million, right? 1, 2, 3, $463,000. Okay, that's what that position will give to me as profit. You see that? So you need to be able to do. So this one that came down here, this market now that came down from year to year, is actually this case, the same analysis here. You come here, you pick your steel blue here, pull back until here, wait for the market to break it. Okay, look for any low in this area. It could be the Aikianshi, right? So it could be this Aikianshi. Look at it here, right here. So it could be between here and here. Okay, so the market break it, came back to this place, and then the market fell down. Came down all the way to this deep blue. This one gives you your take profit, and the market pulls back again, form another. So this is a pullback because it's going against this red, right? So it's a pullback. So in this your pullback, you can also come here, put your trend line, okay, and wait for a break to sell again. Okay. So this one has done its own. But look at this time. If you look at this steel blue, this one was below this. But in this case now, this one is above this. This did not come below this. If it had come below this, would have said, okay, the market is still selling. But now it gave me, this is lower low, lower low, lower low, but this is a higher low. So because this is a higher low, say the market is going to buy. So I didn't see it all time. So my entry is a little bit far off. Okay. this entry is supposed to be close to this point. And then this market will go, in your favor. If this market goes as planned, I'm looking at closing it around here. That's a lot of time. So you need to wait. You need to be able to wait to see, to see this thing play out. Okay, so now the same way I developed this, okay, for 4 hour, you also develop for 1 hour. So you develop for all the time frames. This is 1 hour, so you develop for 1 hour. Let me see the 1 hour on. So I put 1 hour, okay, to still give me similar condition, right? So you see the 1 hour on. So I have this. So yeah, this is my navy blue, maroon, navy blue. The market is buying, right? So this buy that is buying now, even though it has formed a still blue here, telling me that it's going to sell. Now, I'm going to draw a trend line here. This sell is not valid until it breaks all this trend line that I'm drawing now, right? Yeah. Until it breaks this trend line, test it, and then start coming down. But if it doesn't, then this market will still reverse from any of this trend line here and go back up and then run up. So by the time it reverse and come back, it's going to break this still blue and the market will still continue to buy. Okay. So indicators somehow provide a guide for you, right? As in, okay, what's the market doing? It gives you like an idea. In fact, it even helps you to tell you where the stop is. So if I put daily, this is daily chart, right? So you see this daily now. You see this is still blue, still blue. So this move is more like a retracement move, okay, on the daily. But on the 4 hour, it's a massive buy move. On the 1 hour, it's a massive buy move. You understand? So if you look at this move that came up all the way to this place, the market came here, went up, pull back, went up, pull back, went up. Okay, at this time it formed, this navy blue. So this thing is actually time frame, right? So if you open it, you see this is weekly time frame, okay, with a risk of 60. So this indicator, it gives you, it works as per time frame. So you can actually set up like the one you see on the 4 hour, for instance. If you come to this 4 hour and I apply the 4 hour time frame, let me explain this to you so that you understand. You apply this 4 hour time frame here. This indicator, what it does, if you look at this is actually daily. This is daily. This 1 4 40 minutes. You see, this is the candle time frame. This is 140 minutes. This is daily. Okay. Meaning that if this daily appear on this your chart, it's telling you that on the daily, the market is buying or the market is selling. So in this case, the daily is telling me that the market is buying. That's what the daily is telling me. Okay, so if the daily is telling me that the market is buying, then remember, look at this one now. There are two daily conditions here. One is this white that you are seeing at the background. One is this navy, this maroon, and this navy blue. So this navy blue now will go until it is going to meet a red maroon. Once it meets a red maroon, both of them collectively will now sell the market down. Still obey everything you see here, still obeys your Fibonacci 100%. I don't know if you get me. If it's all this, you see, if you measure, you see that it still follows your Fibonacci. Like if I measure this to this and see this pullback, see where this pullback came to, this is the extension. If you measure this to this and see this pullback, this is the extension. Now, this to this and this, remember what we just did? This is not your D, because the market was not able to progress to break your A. So this is a C, and this C will lead to a D. You understand? So as a trader, you need to be able to manipulate indicators and create a trading system for yourself. That will reduce it will reduce your time to analyze. If I come to this chart and I just put my H4 system and I see that the criteria are not met, I just move to the next chart. Okay, so that one no favor me, go to the next one. You understand? If that one no favor me, I go to the next one until I see the one that meets my criteria. Once I see the one that meets my criteria, it's easy. You understand? See this GBP USD now that bought all this buying, that Euro USD and GBP USD. Look at this. This is your navy blue buy. Telling you the market is in a buy direction. And then you now see 1, 2, 3. Draw your trend line, break and buy. Trend line, break and buy. This one is doing another pullback now. Maybe by the time this market comes down, below this level and give me another steel blue, draw my trend line. By the time I break that trend line, the buy continues. In as much as it has not formed a maroon red here, the buy will continue, except it comes and form a maroon. Now it hasn't formed maroon. It hasn't formed maroon yet. All these things, it takes time. You need to sit down and alter figures, change figures on indicators. You have to do it. You will do it until, see, like this one now. We are talking of pattern, right? Okay, look at this pattern that moved this market. Now this is GBP USD. This is your A, this is your X. So if I come here, this pattern is, if I pick this, this is your X, this is your A, and then this is your B. Okay? And you pick this. So this is your B, this is your C, and this is your D. So this is A, B, C, D. You understand? So this pattern now is what is driving all this movement. Are you seeing it? Now it's easy for me to see it now, to see it here, because if you look at, let's take it back. If you look at this, I see that the market is coming from a navy blue, right? Now it went from this navy blue to this red maroon, this maroon red, and then in between this red maroon and this next navy blue that did not get to this navy blue, I have A, B, C, D. You understand? This is AB equal to CD. So the number of pips the market move from here to here will be somewhat equivalent to the number of pips the market move from here to here. You understand? So this AB equal to CD, that is directly coming against this, your navy blue, shows you that there is a pattern. So if you now go and start doing your measurement, so let's try the measurement. For come here, we said if it's a Gartley pattern, then from here to here should give us 78.6. Look at it. It's a perfect Gartley pattern. Okay, so let's see this one. We said this one, we say from here to here should give us 61.8. And look at this one. This is a perfect 61.8. And we say from here to here will give us 61.8. So let's measure this one. Measure this one to this one right here. Look at it. Perfect. Can you see it? Look at it, 61.8. So the measurement from here to here, we say this is 61.8. The measurement from here to here, we say this is 61.8. And then we said when this one gets to its D, when this one gets to its D, the measurement from year to year should give us 78.6. Why also, we have a range of 1.27 to 161.8 for year. Okay. So this is a very good brand. And when you even pick it, by the time you pick it and pick 1, 2, 3, okay, and pick again, 1, 2, 3. Even from the shape, you know, you can see it's looking like a real Gatling pattern. And then from here now, the market starts buying. And even in the buying, it's still doing A, B, C, D. B, C, D. B is coming back to another C. By the time I get another still blue, I watch out for another stretch of a long buy. See that? All right. I think this is clear enough. Is it clear to you guys? Or is it looking confusing?
I think it's I have to do some practice
Yeah,
to be
you
able to
have to
digest
practice.
the concept.
You need to practice it well. Once you practice it well, you'll be able to apply it. It's very important to practice it and know it.
Yeah.
So, Ansing, you ask a question, in the course of the week. So let me try to explain it to you. So if you come to any broker, it doesn't matter. If you come to any broker, let me use FSTM as an example. If you come to FSTM, this is their main page, right? FSTM. All right. So you come to trading. There's another trading here. You come to this platform, account platform tools overview. Oh, what happened? My network. Hey, my network disappeared.
Oh, are we still there? I have lost my audio. I can't hear you either.
Okay.
Sorry, I was muted. Can you hear me?
Yes,
Yes, we can hear you now.
Okay. So, answering specifically for you, you asked a
So,
question around this, okay? And I want to try to explain it to you. So when you are trading, before you place a trade, it is advisable you go to your broker website and take a
okay.
look at this information, okay?
Okay.
Let me take it back. This is the main page. In FSCM, it's under market. Another market,
Okay.
you see instrument. Under instrument, you see contract specification. Click on contract specification. Okay. They may call it a different name in every other broker. It doesn't matter, but it's the same thing. So under contract specification, yeah, you can select whether you want to select Forex, major, equity, stock. It doesn't matter. Yes, you said yes, Forex, we're on major. This major, I can change it to minor. I can change it to exotic. If I change it to minor, all this currency, they will change. If I change it to exotic, you see all these things will change. It's very simple. Okay. So now let's go to major where we are dealing with. So let's take AUD USD for instance. This is a table, and if you look at this table, there is a ticker, which is the currency, the name of the currency. This is Australian dollar versus US dollar. Okay. The minimum spread is 0. The PIP value we are talking about here is 0.1. And then the swap for the, so if you are trading AUD USD and your lot size is 0.1, if you are selling, your swap will be positive. But if you are buying, your swap will be negative. You see that? If your action is a buy, your swap is negative. That means for every 0.1 lot that you take, this company is going to charge you minus 4. They're going to charge you $4, right? $4. So this $4 on a Wednesday, if you take the trade on a Wednesday, and that trade runs from a Wednesday into Thursday, there's what we call triple swap. Every broker in the world does it. Every broker. Triple swap means that if you take this 0.1 lot size on AUD USD on a Wednesday, and that trade stays on until Thursday, this your -4 will become -12. It will be -4 times 3. Okay. So if you were trading, let's say you were trading and your trade was making a profit of $10. Your $10 plus -12 is -$2. So they would have taken the swap would take $12 from your $12 from what you are trading. So if the amount that the swap is taking is higher than your profit, then your profit will be negative. But if your profit is higher than the swap, the value of your profit will reduce. But the reverse is the case. If you are not selling, you are buying. If you are not buying, sorry, if you are selling. If you are selling, this is what will be applicable. 1.32. And on a Wednesday, this will be 1.32 times 3, which is like 3.94. Okay. So any amount you are making, if you are making like say $10, you are going to be having $10 plus 3.94. So you will be seeing 13 point something dollar in your effective trading profit that you are making. Okay. Why? If it's negative, in the same vein, it will go down. So, and I want you to always look at it because some are very big. See USD CHF. If you are selling USD CHF, look at what you are looking at. And if you take this kind of trade on a Wednesday and it has to run through Thursday, you are looking at close to $40, okay, that you are dashing to the broker.
Does this apply to every broker?
Yes, it's applied to every broker.
Every Wednesdays.
Yes, every Wednesday, yes,
Thursdays.
triple swap. It's applicable to every broker. But any other day, Monday, Tuesday, Thursday, Friday, they will just apply only this value without the times 3.
Wow.
But on Wednesday, you will see the
Okay.
effect of that times 3 everywhere in the world.
Is this also called the administration fee? Is it
Yeah,
called
this
administration
so
fee
some
as well?
people will call it administration fee, but in reality, it's actually called swap. Now, and it's also a function. What determines it is, you see these two guys, US dollar and Swiss franc. So if this one now that says buy negative and
I understand.
sorry, sell negative and buy is positive, is a function of the interest rate between these two countries.
Okay.
That's how it's determined. Okay. And if you now go to, let's go to something like commodities. Okay. See crude. Look at crude. Brent. Look at Brent. And you are risking, if you are selling, your swap is negative. If you are buying, your swap is negative. Anyone you do, your swap is negative. If you are buying if you are selling on a Wednesday, this is minus $75 from your money.
Oh.
Are you seeing that? But look at corn. Look at corn. If you are buying, if you are selling 91 on a Wednesday, this is additional $180 free of charge for you.
Oh.
Look at this one. If you are buying minus 130 on a Wednesday, that is more than almost $400. So if you are not looking at this information and you are just trading, look at this one. Soya beans. It's crazy. If you are not looking at this information, you just go and start trading. When this is start impacting on you, you would think that the broker is tricking you. And I have an indicator that also helped me manage this. So if I come back to my indicator, look at this info board. This indicator is called info board. So Euro USD, swap long is negative, swap short is positive. Are you seeing it? So if I buy Euro USD now and I keep it till tomorrow, I'm going to be losing minus $5.9. Why if I sell, I keep it till tomorrow, I'm going to be making $1.29.
Wow.
Okay. If I keep changing that, you keep seeing the see this is USD CHF. Can you see that? Now look at this information and let's go back to this place here and select Forex back. And I want you to go to major and let's look at USD CHF. USD CHF. Are you seeing it? Is this not minus 13.49? Is it not
Yes.
6.51? Now come to the indicator I'm showing you on my chart. Look at it. Minus 13.49 and the same 6.51.
How do we apply these on our chart? The info board.
This info board, maybe I'll need to send it to you. Send it to
Okay.
I'll send it to the WhatsApp group and just pick it from there. Then put it on your chart. It's simple. I'll send it to the WhatsApp group, pick it for there, just download it from there, then put it on your chart. So all the currency, you see Brent, look at it. Corn, natural gas, NZD card, Euro CHF, GBP CHF. So you need to look at this information before you make the decision. So you might have done the analysis. You may have done the analysis. So let's just apply this is H4. So apply H4 here.
Another issue, another thing I noticed, their currencies are not straightforward. So if you have GDP USD, you have GDP USD dash ECN. So if the GDP USD, you can't trade it directly. So you have to trade it. I think they probably they copied the trades or the chart. I don't know. So I think we have to trade through their platform. So it's like without trading their own GDP USD ECN, you cannot trade with on their platform. And I think FXTM is different. With FXTM, you can trade directly. You can trade GDP USD or CHF USD or JPY or USD JPY directly. I don't know if I make any sense.
Okay. So let me do something for you. So if you come here, I think I can just take it from here. Log into trade account, and then yeah. So these are servers now. If you look, this is SM servers, this is Top Step, this is FSTM, this is AVA, okay, this is SM. Let me see which one is there again. All right, so look at the FSTM server. You see FSTM sent demo, sent ECN 0, standard demo, okay. So now each of these server, they have a document, a terms of reference. Okay. That terms of reference tells you the minimum spread, the maximum spread, majorly the future of this of any account that you open that is under this server. Okay. So if you don't know, if you have not read that document, you may be confused by the time they start applying some things to your account. Okay. So if you look at look at FSTM now, you see this currency pairs, right? Now I'm going to open deriv. Okay, let me show you something. Now, if you look, so so if you look at the sent account, the ECN account, for people that cannot stand, maybe high volume money, okay, they are advised to deal with, the smaller account, which is like the cent account. So it's more, it's like there's a factor that multiplies your amount, okay, that you are trading. So effectively, if you are trading a cent account and it's showing you 1,000, in reality, it's like $1, right? Or $10. Okay. But somebody that is doing ECN, 1,000 could be really, really 1,000. Okay. So if you look at this now, this is deriv. So in this deriv, you will see that you may have different type of GBP USD. I just want to see if I can get sometimes I just explain it to you. So you will see some people that will have GBP USD and then some have GBP USD mini. Okay. Or some they will have GBP USD and they will put like a symbol, in front of it. Let me see. Euro. And I've seen something like that before on the reef. Or was it not the reef? I saw it. Well, I'm not sure. So basically, the most important thing is for you to understand the terms of reference of the account that you are operating. It's just like you opening a current account in a UBA or First Bank. They will give you a document at the back. You will see terms and conditions. So you're supposed to read that terms and conditions to know what are the features of that account and what the kind of charges you expect. But some are intentionally, they make those things very small. People are discouraged, not to read them. But in this case, it's a document that you can see, right? You can actually download it. I remember downloading all the accounts when I started using FSTM the first time. Okay. So if you do that, you'll be able to understand what you are dealing with. And if you feel uncomfortable, you can easily switch your account or change your broker. If you feel the broker is not giving you what you want, there are a lot of brokers out there, that have different conditions. You can change your broker and use another broker.
Do you know any best broker to use in UK? Anyone you can advise?
Let me see.
Can recommend?
Just 1 minute. Let me see. list of UK. So let's see. So I think you can go with Oanda, right? Or you go with FS Pro if you're in the UK.
Oh, okay. Wonder or
Either you
FX.
take Oanda or you take FS Pro. From this list I'm seeing now, you can see my screen.
Yeah.
Okay. These two I know very well.
Okay.
Yeah. So you take any of those three.
Thank you, sir.
Hello, Patrick. Good evening.
Good evening, sir.
Please, based on what you've just explained about this negative spread and positive spreading, how does it affect somebody that is trading on Naira? And what is the advantage of trading in Naira, FSTM, and trading in dollar?
Okay, so it's basically the same thing. There's no difference whether you are trading in dollar, whether you are trading in Naira. The only thing is that when you trade in Naira, you see Naira and the volume, the figures you will see will be high. Okay. While you are doing that same trading in dollar, you will see the equivalent. But here is the deception. Okay. The deception is this. If you are trading in Naira account, let's say you have 1 million in your Naira account. You know that your 1 million, you may be tempted to say, oh, I have 1 million. 1 million is big money. So because of that, I want to use one lot. Before you think about that, what you need to do first is to first of all come to your calculator and say 1 million divided by 1,650. Just do the mathematics in your head. Effectively, what you have is actually $606. So you cannot use one lot to trade a $606 account. But if you are looking at the value 1 million, you will think you have so much money. And you are going to put that one lot on your 1 million account. And when the market do one negative swing against you, you just discover that the 1 million has disappeared.
That's
And you'll be
correct.
wondering, do you understand? You'll be wondering, but I have 1 million. The 1 million is a lot. In reality, it's not a lot. You understand? This is a
That's correct.
$600 account, and the maximum you can use to trade a $6 account is 0.06 lot. That's the highest you should use. Anything other than that, you are over leveraging the account. You understand? So in effect, there's no difference. The
Okay.
only difference is just the name, currency, just the currency name. All you need to do is just because we are used to trading in dollar, right? So we always want to make reference to dollar. Because all your lot size, if you look at this thing I'm explaining now, you will see that the reference is to dollar. You understand? So anything you are doing in the market, just make sure, because the internationally accepted currency for this kind of business is USD. So, and
Yes, sir.
if you look at the market, everything is more like relying or depending on the USD. That's why
That's correct.
the two most traded currency pair in the world is GBP USD and Euro USD. In fact, Euro USD is the highest, the most traded in the world. So the highest volume of trade you ever find in the forex market is on Euro USD. Okay, so at the end of the day, the USD is the key currency in the forex market. Everything we do revolve around the USD. So it's better to actually trade in USD. But one advantage that the Naira offer to you is when you withdraw. When you withdraw Naira, you don't have to wait for that conversion process to take place, right? When you withdraw
Yeah.
Naira, that transaction is processed faster to you. And if you trade in FSTM and you withdraw USD, because you cannot fund USD direct, you may want to be withdrawing that to your card. And when you withdraw USD to your card, it will take minimum of 5 to 11 or 10 business days, before that money drop in your account. So that's the little difference. But if it's Naira, as you are placing your withdrawal, trust me, maximum 3-4 minutes, the money is in your account.
Okay.
That's how effective FSTM is.
Thanks for that. Appreciate it.
So, Sir Patrick, you said if you're using dollars, it doesn't drop immediately into your account for withdrawing.
Yes.
Any
Because
reason?
you're not withdrawing the dollar to your account. You are withdrawing it to your card, that card I used to fund. So it's going to go through Visa, it's going to come back to your account.
Okay, okay. Because the original money is in pounds, for example. Then when I converted it into trading account, which is in dollars. So if I'm withdrawing into my card, it has to go through all this process to get back to pounds, isn't it?
Yes, you need to go through that conversion process to get back to you, correct?
Okay,
Because
okay,
your
makes
card
sense.
is dominated in pounds. So
Yeah,
that money will come to you in pounds, not in dollar. But effectively,
okay,
what you are withdrawing is dollar.
okay, okay. Thank you.
Okay, any other question from anybody? So I will drop this info board. Let me see if I can do it now. Info board. MQF4 indicators. Info board. So let's copy it like this. Let me just copy it first, then drop it on desktop. Yeah, to compress. Okay, so copy, then drop all this. Okay, so you can pick it from there and put it on your MT4. So remember the process of putting it. Now I've sent it as a zip file. Open the zip file, extract the file from the zip file, copy that file, come to your MetaTrader 4, click on File, click on Data Folder, click on MQL4, click on Indicators, and paste it on Indicators. Once you finish pasting, close this, close the MT4, open the MT4 again, click on Navigator, look for Info Board. You will see it like this. Just double click on it and click OK. It will be on your chart. As I'm talking now, somebody can do it. It doesn't take time. Okay.
It says no file to preview.
Let me see. It's there now. Are you using a computer?
I'm using the phone.
No, it will not work. Go to computer. When you go to computer, Once you download it, it will come as a zip file like this. Open the zip file, pick this indicator. Sorry, I'm taking it. I can go to the desktop. It will come like this info board. Open it and pick this one. This is what you are going to copy. It's so if you're depending on your this thing, look here, see, extract. Depending on the computer you are using, some they will need you to extract it first, some you can copy it direct. But with Windows 11, you should be able to copy it direct without extracting. But if it's giving you a problem, you click on extract first, then it will come out of this zip file. If I click extract now, it will come out, just come here and say extract to desktop. It will come out of the zip file, okay, and enter into a normal folder like this. Look at it. When you extract it from the zip file, it will come into a normal folder like this. Just double click on the folder, pick it, copy direct. Copy, and then go and paste. It will work. But you must use a computer, not phone. Okay.
Thank you, sir.
All right. So, any other question from anybody?
Yes, Patrick. One experience I've also had in the using of use of some of these trend indicators is that most of them repent. I don't know if there's any good one that doesn't
Yeah.
repent.
So I just explained now that they will repent, right? But then you can check their repenting action with price action. Okay. So let me put an indicator here, for instance. There's that FIP. So if I put FIP here now, good. Look at this FIP. See this arrow now that's showing here. That doesn't mean the first time it appears is here. It's possible the first time it appears even here.
Yes.
And then the market pushes it. When the market is pushing it, look to your left. The market is going to push it until it gets to a previous support or resistance. When the market pushes it, look at it, this is a previous support. When the market pushes it to a previous support or resistance, the chances that the market will push it beyond there will be slim. Do you understand?
Yes.
Chances will be slim. Look at this one that you are seeing here now that is good. That doesn't mean that it appears here. If you come here, if you put this line here, look at this. You see that this, when it came down, this is a previous, a place the market has respected before. And it's coming there a second time. And it respects it. And the reason why you see that this one is going down and look at it is because this place is a support that has turned resistance. That's why this market is coming down like this from here. In fact, it's even a place the market has touched. It touched it here, it respected it. It touched it here, it respected it. It break it here and came back here and tested it, and then it's respecting it. So in this case, when the market hits it here like this, you put this line here. All you need to do is to pick your trend line from here and draw it here and watch the break. Watch the break, then the retest, and then the sell.
Okay, thanks for that. There's also one problem I'm experiencing on my MT4. If I switch on my MT4, my server doesn't connect. Most times it will spend hours and I cannot do anything until whenever. Sometimes it does not connect at all, and sometimes it just come and then after several hours, and it's actually obstructing my entries.
Is it FSTM?
Yes, FSTM 4.
When did you open the account?
I opened the account about a month plus now, and I funded.
Okay, so it could be your internet. Maybe your internet is not strong enough.
Okay.
Check your internet. I think it's the strength of your internet. If your internet is strong,
I
issue.
even have I even have two internet connections. Before I was using MTN internet from my phone, but now I am using what's it called? Well, this one with green this thing logo, and it's also
Is it Glow?
no, not Glow. This is external this thing.
Smile.
Smile. I'm using Smile now. I'm still having the same experience.
Well, that I believe is something that is related to your network.
Okay. I'm thinking of going to their office here in Port Harcourt if they can sort it out.
Yeah,
I don't know.
you need to check with them.
Okay. All right. Thanks.
Okay, guys, if we don't have any further question, I think we need to call it a day.
Thank you very much. Much appreciated.
Okay.
Thanks a lot.
All
So
right.
just
Thanks.
before you go, you
Thanks,
said
everyone.
we go to on FXTM, we go to Navigator, right? We want to copy the
The
file.
indicator.
I'm trying to copy it.
And when you finish copying it now, first of all, have you downloaded it from the group?
Yeah, I've downloaded it. I can't do it on my phone. I'm trying to send it to my laptop via email.
Yeah, okay. So you need to do it on your laptop. When you open it once you are able to copy the file, once you are able to get to this point, I can see the file like this. Just right click on it and copy it. Then once you copy
Yeah,
it, go to your trading platform. This is your FSCN trading platform now, or any broker.
yeah.
Click
I've
on
opened my trading
file.
platform.
Okay.
File,
Click
yeah.
open data folder.
Open data folder.
Then you come here. Then click on
Yeah,
MQL4. Click on indicators. And then
indicators, yeah.
paste anywhere. Paste on a space. Don't paste it on any of these folders. Paste it
Yeah,
on
just anywhere.
space. Yes, a space here. Paste.
Okay.
And that's it. Then after that, you close it, close the platform completely, then restart it, and your indicator will
Okay.
appear for you.
Lovely, lovely. Thank you very much, Patrick.
All right. Thanks everyone. And do
Thank
have
you for your
a
time.
wonderful
God bless
night.
you massively. Thank you.
Thanks. God bless you too.
Right, right, right.
Bye.
Thank you very much, sir.
All right, bye. Money.